Today we are going to discuss about insurance. The topics that need to be covered under this module is insurance products and services, types of insurance, life, marine, fire, medical, general insurance, life insurance products and general insurance products. Let's start with what is insurance. See, it's a contract between the insurer and the insured under which the insurer undertakes to compensate the insured for the loss arising from the risk insured against. In consideration, the insured agrees to pay a premium regularly. You're confused, right? So who is the insurer? Who is the insured? We need to understand that before we look into the meaning. See, the person who takes the insurance is the insured. Okay, if you are taking a life insurance for yourself, then you are the insured person. Insurer is the insurance company, the person who agrees to bear the risk of the insured is known as the insurer. So look at that meaning again in simple words. Insurance is a contract between the insurer, that is the insurance company, and the insured, the person who's taking the insurance. So what is the agreement under this contract? Under which the insurer undertakes to compensate the insured for the loss arising from the risk insured against. So whatever risk it is that the insured wants protection against, the insurer will give the protection provided the insured agrees to pay a premium regularly. So there is a risk against which you need protection. So you will approach an insurance company, and that insurance company will be known as the insurer, and you will take an insurance and then you will become the insured. And in return for protecting you against the loss, how does the insurance company protect you against the loss? On the happening of an event, that is, suppose someone dies, the breadwinner of the family dies, and there's life insurance in his name, then a predetermined fixed amount will be paid to that family as insurance. So on the happening of a particular event, a fixed amount might be paid to you, and thereby the loss will be covered. Or on the happening of a loss, you will be compensated with the amount of loss. If you're taking a fire insurance for rupees 5 lakhs and a fire has occurred in your premises, and the loss actually incurred is 4 lakh, then 4 lakh rupees will be paid to you. The loss will be covered. So either on the actual happening of an event or on the happening of a contingency, some sort of a risk, the insured person will be compensated by the insurer. So what is the consideration that the insuring company gets? The company should get a premium regularly from the insured. That is, in consideration for the service provided by the insurer, the insured agrees to pay a premium regularly. We have to pay a fixed sum of money regularly to the insurance company, and this payment that we make regularly is known as premium. So insurance may be defined as a contract consisting of one party, that is the insurer, who agrees to pay to the other party, that is the insured, or his beneficiary. Okay, we can set a nominee to collect the amount. So it could either be the insured or his beneficiary. A certain sum upon a given contingency, a certain sum will be paid upon the happening of a particular type of risk against which insurance is sought. I hope you're clear what is insurance. So there are two parties. There's an agreement between them. One party agrees to compensate the other party in return for a regular payment known as premium. So let's familiarize with each of these terms. Insured. Who is the insured? The person whose risk is insured is called the insured or the assured, the person who takes the insurance policy. Now, premium, the person who agrees to compensate the loss arising from the risk is called the insurer or assurer or underwriter. The insurance company who will agree to compensate the loss of the insured is known as the insurer. Premium, it is the consideration paid by the insured to the insurer for the risk undertaken by the insurer. So it is a payment made by the insured to the insurer. It is paid at a regular interval. Now, how is the premium determined? The premium is determined based upon the level of risk. If the risk is high, then the premium charged will also be high. Policy. The instrument containing the contract of insurance is called a policy. We're taking an insurance policy. This insurance policy consists of all the agreements and conditions between the insured and insurer. Subject matter. The things or property which forms the basis of insurance is called the subject matter of insurance. So for whatever purpose you're taking the insurance, that is known as the subject matter. If you're taking a life insurance policy, then the life of that particular person is the subject matter. Now, what is insurable interest? The interest of the assured in the subject matter is called the insurable interest. To what extent is the insured interested in the subject matter? We can measure that in monetary terms. That is known as the insurable interest. Assurance. It refers to a contract which guarantees the payment of a certain amount on the happening of an event which is sure to happen. See, what is assurance? It is an agreement or it is a contract, and this contract guarantees the payment of a certain certain amount. When do they agree to pay the certain amount? On the happening of an event which is sure to happen. We know that event is going to happen. We don't know when it is going to happen, but we are sure that it will happen. So the happening of that event, the insurer will agree to pay the insured. So that type of a contract is known as assurance. Example, death of a person. So what is insurance? It refers to a contract which guarantees the payment of a certain amount on the happening of a certain event which may or may not happen. So they are agreeing to pay a certain amount as compensation on the happening of an event, and this event may or may not happen. Example, fire, theft, flood, etc. So we can say that assurance is applied to life insurance contracts because we know death is inevitable. Everyone will die at some point of time. So at that time, you will be assured a certain amount. So you're sure that you will get that promised amount in future. And the term insurance is applied to general insurance contracts, whereby you will take insurance, but you don't know whether that event will happen or not. If that event occurs, then you will get a compensation. If not, you won't get anything. So occasions like fire, flood, theft, etc. are examples. If you take a marine insurance, fire insurance, health insurance, these are all general insurance contracts, and it is used to define the term insurance. What are the features or the nature or characteristics of insurance? The first feature is sharing and transfer of risk. See, a lot of people who face the same sort of risk come together. That is what happens under insurance. They are sharing their risk or they are transferring the risk to someone else. A lot of people will come together, they will contribute premium, and compensation will be given to the person who suffers the loss. And the insured is transferring the risk to the insurance company. They do not want to bear the risk, so they are transferring their risk to the insurance company. Second one is a cooperative device. See, the policy behind is all for one and one for all. The insurance is a method where large number of persons who face a similar risk are covered, and the risk is spread over a large number of people. So we can say it is a cooperative device. Suppose there are 10 people who face the same sort of risk. Each of them are required to pay 10,000 each on a monthly basis. So they keep on paying that amount for a year. So each person has paid 1,20,000 by the end of the year. Now suppose one of the persons suffered a loss worth rupees 3 lakh. Then the premium collected from all these people will be pooled together and 3 lakh rupees will be given to the person who actually suffered the loss. So everyone is working together to get a protection from the risk that they face. Value of risk. Now, what is the value of the risk? How will we determine it? We will evaluate the value on monetary terms. This is based upon the probability theory. If the probability of happening of risk is more, then higher premium is fixed and vice versa. Certainty and contingency. See, life insurance is a certainty because we know that the person will die and the amount assured will be given to the insured in a future period. Contingency, that is on the happening of a particular event, that is either fire occurred or some sort of a marine peril was faced. In that circumstances, compensation will be made for the actual amount of loss that has been suffered. So you do not know the amount that you will get, you only know how much loss is going to be covered. Then amount of payment. The amount of payment depends upon the value of the loss occurred due to a particular insured risk. In the case of life insurance, the insurer promises to pay a fixed sum on the happening of an event. But in general insurance, the amount as well as the happening of loss is required to be proved. You will first have to prove that you have lost so much in that particular event, and then you will be compensated only for that particular loss. So the amount of payment has to be claimed. Large number of insured persons. We have already explained that point. A lot of people who face the same risk will come together and they will contribute a fixed amount regularly known as a premium, and the person who faces the loss will be paid out of these premiums. Now, insurance is not gambling. We cannot say insurance is gambling because we do not agree to compensate a gambler. The gambler is someone who enjoys risk. He is willing to bear the risk, so he cannot go around covering the risk. Law prohibits the use of insurance for gambling purposes. So we cannot say it is a gambling. Now, insurance is not charity. Charity is given without consideration, but insurance is not possible without premium. We get a consideration known as premium in order for giving this risk coverage. So insurance cannot be said to be a charity. The insurer, the insurance company is getting a consideration known as premium. Based on certain principles, there are certain principles on which the insurance is based. We'll learn each of these principles in detail after some time. Regulated by law. All the actions of the insurance company is regulated by a supreme authority known as the IRDA. What are the functions of insurance? The functions can be classified into three. There are primary functions, secondary functions, and indirect functions. Under primary functions, there are three main functions. The first one is to provide protection. Second one to provide certainty, and the third one is distribution of risk or risk sharing. Provide protection. We know that the insurance company guarantees to compensate in case of a risk or a loss. So they're giving a protection to the insured person. To provide certainty, that is, you know for sure how much amount you're going to get in the future in case of a life insurance, or you know for sure how much of your loss will be compensated in the future in case of general insurance. So it provides a certainty to the insured person. Distribution of risk. See, the risk is shared among a lot of people who are exposed to that risk. The share is obtained from each and every insured in the shape of premium. Secondary functions consist of prevention of loss, provides capital, improves efficiency, and helps economic progress. How does it prevent loss? See, insurance company is collecting funds from a lot of people in the form of premium. And they will also provide a part of this amount collected as financial assistance to health organizations, fire brigades, and other organizations which are engaged in preventing mass death or damage. So the loss will reduce, right? See, suppose medical insurance is taken by a lot of people. We are supporting medical organizations. And because these medical organizations are performing really well, people are getting good treatment and the actual loss suffered is going down. So lesser payments need to be paid to the insured person or the assured person, and thereby the insurance company will be able to get more savings. Now, when they have profits, when they have savings, they will be able to afford insurance coverage at lower premium rates. Now, when insurance is available at lower premiums, more and more people will be willing to take up insurance and more amount will come to the insurance company. And they will be able to protect large number of people. So it helps in prevention of loss. It provides capital. The accumulated funds that is collected in the form of premium from a lot of people are invested by the insurance company in productive channels. Both individuals and business organizations will benefit by the investments and loans of the insurers. Next is it improves efficiency. See, once an insured person transfers the risk to the insurance company, then their mind is free, they are stress free, they can concentrate more on their and other aspects of their business. So this helps in improvement of efficiency. Now there are some indirect functions of insurance. The first one is forced savings. Now in the form of premium, the people are required to set aside a certain amount regularly. The income taxes relief is also given for the premium paid. So it develops a habit of saving or a compulsory saving among the people. Promotion of foreign trade. See, foreign trade depends entirely on insurance. Bankers will not discount the marine trade bills unless the cargo is fully insured. See, in our country, insurance is compulsory for foreign trade. So there are other functions also. See, it creates confidence among the general public. It provides a source of investment and helps trade and commerce to develop in a faster rate. It also helps in the economic development and overall progress of the country. So these are different functions of insurance. Moving on to the next topic, we need to see what is the important uses and benefits of insurance. So let's see what are the benefits to an individual. Insurance will provide security and safety to the individuals, right? They are agreeing to pay you in case of a contingency. In case you face some sort of a loss, they are agreeing to compensate your loss. So they will give you a sense of security and safety. Now, once you feel secure, you will enjoy peace of mind. That is the second benefit. So insurance affords peace of mind. Suppose you are taking a motor vehicle insurance. You can sleep at night peacefully, knowing that even if your vehicle gets stolen, you will be compensated. So it offers peace of mind. Insurance protects mortgage property. At the premature death of the mortgager, the ownership passes to the moneylender and the family is deprived of the property. But if the property is insured, the insurer pays off the loan and the dependents retain their right over the property. What is mortgage? You have given a particular property for loan. Now, in normal circumstances, if the person who is the owner who has lent it out or who has taken a loan on it, if he dies, the moneylender gets the right to sell off that property and take the money which is due to him. But in case we have taken an insurance for that mortgage property, the insurance company will pay off the debt and the dependents can get the right over that property. Insurance eliminates dependency. Suppose the only earning person of a family dies and there's a life insurance in his name, then the family need not depend on anyone else. They can get financial aid in the form of insurance amount. Life insurance encourages savings. You're required to make regular payments in the form of premiums, right? So you're asked, you see, in some life insurance, they will agree to pay you a fixed amount on the completion of a certain period of time. They will not wait till the death of that particular person. Upon the completion of a certain period of time, you will be given a fixed amount. So life insurance encourages savings among the people. It provides profitable investment. So we'll get tax benefits for the amount that we pay as premium to insurance companies. Now, what are the benefits to the business? See, uncertainty of business loss is reduced. I've already explained that point. The business efficiency is increased with insurance. We know once the business is relieved from the worries of facing loss, they can concentrate on more relevant issues and thereby increase the efficiency. Key man indemnification. See, who's the key man? He is the most important person in your business who is actually contributing to the profits of your business. Now, suppose something happens to him, then your company is going to suffer a loss. Now, this key man could be a director of a company, active partner in a partnership business, the main sales people, the main project managers, or people with specific skills. Now, once you have taken a key man insurance, it provides the firm with the opportunity to protect its business against the unfortunate loss of these people. In case something happens to that person, a compensation will be given to the company. Enhancement of credit. You can take loans by pledging the policy as a collateral. Even if the borrower is not in a position to clear the debt, the lender can surrender the policy and get the amount of loan and interest repaid. So insurance policies are the best collateral for business loans. Now, welfare on the employees. We are seeing that we are taking an employee insurance policy nowadays, so that in case the employee meets with an accident or faces premature death or dies because of old age or faces some sort of a sickness, then the loss will be, or a fixed sum will be given to the insured. Now, there are certain benefits to the society as well. It helps in capital formation. I said the amount collected as premium is invested in various productive ventures. So it helps the society in capital formation. Reduction in inflation. The main cause of inflation is because there is increased money supply in the economy and decreased production. When premium is paid, money supply reduces because the amount is collected by the insurance company from the public, and it is invested in productive ventures, so production also increases, and thereby it helps in controlling inflation. It offers protection to the society's wealth. Insurance attempts to provide protection to the wealth of the society. Life insurance protects financial losses, and property insurance indemnifies any loss of damage to the property. It leads to the economic growth of the country. Social security benefits are also received. See, the state wishes to provide provision of old age, sickness, disability of person. They wish to protect these type of people. Through insurance, this objective is achieved. Now, removal of social evils. See, in case of death, if a family becomes abandoned, they do not have any source of income, then they will turn towards robbery or theft. But because there is insurance, they can live without depending upon others or turning towards any social evils. Huge funds. Insurance accumulates from the small deposits of many persons, and this large fund which may be invested and used in the development of industry and society. The fund that you collect as premiums will amount to a huge fund, and this huge fund can be invested and used for the development of industry and society. So these are the different benefits to the individuals, business, and society because of insurance. Now, what are the essentials of an insurance contract? there should be a written agreement. There will be a proposal form, and this form needs to be filled in. And there are other agreements between the insurance company and the insured in the form of writings, and there should be, every agreement should be in the written format. Second, there should be a consideration. The consideration for the insurance company, that is the insurer, is that premium, and the consideration for the insured is the compensation paid at the time of the loss. Competency. Only a person who is competent to enter into a contract can take insurance. That is, he should be of sound mind, he should be 18 years of age, and that is the rules that need to be followed. He should be a competent person, the insured. Lawful object. Whatever is your subject matter of insurance, it should be lawful. You cannot take insurance of a vehicle that you have stolen from someone else. You can only insure something which is lawful. Mutual faith. There should be a mutual faith between the insured and the insurer, that both of them should not try to trick each other. Certainty. The agreement between the insured and the insurer should not be vague, loose, or uncertain. The terms and conditions should be clear to both the parties. It should be possible to perform. The agreement must be capable of being performed. A promise to do an impossible thing cannot be enforced. Contract of subrogation. The doctrine of subrogation is applicable in case of general insurance, where the insurer is compensated for the loss caused by the damage of the property insured by him. The right of ownership of such property passes on to the insurer. Suppose you have taken insurance for the machineries in your company. Now, on the occurrence of a fire, the entire machine was burned out, and the insurance company has compensated your loss. Once they have compensated your loss, they can take this machinery and sell it off to get a scrap value. So once their loss has been compensated, the right over that particular property is taken up by the insurance company. So it's a contract of subrogation. Insurable interest should be there. A person cannot enter into a contract of insurance unless he has insurable interest. See, I can take insurance for my children and spouse, but I cannot go and take insurance for some other stranger who is of no use to me. I should have some insurable interest in the person I am taking insurance. The same applies to general insurance also. The last topic for today's class are the different principles of insurance. We need to be familiar with the main principles of insurance. The first one is utmost good faith. According to this principle, both the insurer and the insured must act in good faith, and they should disclose all known and material facts to each other regarding the subject matter. Now, this rule is applicable particularly to the insured person because he is the person who is in possession of the subject matter. Therefore, all facts should be disclosed to the insurance company. If they engage in some sort of a concealment, then they will not be allowed to claim insurance. Second is insurable interest. See, in simple words, insurable interest means monetary interest. So a person cannot enter into an insurance policy unless he has got some sort of a monetary interest in the subject matter that is being insured. A person is said to have insurable interest in the subject matter if he suffers financially by its loss or destruction. So a person has insurable interest in his own life, in the life of his spouse or child or debtor. Similarly, the owner of a property also has an insurable interest in it. The third principle of insurance is indemnity, whereby the insurance company will agree to compensate only your loss. Suppose your insurance policy is for rupees 20,000, but the loss that you suffered is only 15,000. Then the insurance company will only give you 15,000. The actual loss will be covered. Suppose the policy was worth 20,000 and the loss suffered was 25,000. In that circumstance, the insurance company will pay you the entire insurance policy amount, that is a 20,000, because they have agreed to cover only loss up to that limit. So that is indemnity. The fourth principle is subrogation. I've already explained that. See, in case of subject matter is not applicable to life insurance, this principle of subrogation is applicable only to general insurance. Suppose the subject matter is completely destroyed and the insurance company has paid the compensation amount. The insurance company can now take hold of that destructed property and deal with it according to his wish. Next is contribution. See, contribution is with regard to double insurance. Suppose I have insured the same subject matter with 2 or 3 insurance companies. Then according to the principle of contribution, all these 3 companies should jointly contribute in such a way that only the loss is covered and the insured is not given any sort of a profit out of that double insurance. Suppose you have taken a policy for 1,50,000 from 2 insurance companies and the loss suffered is 1 lakh. Then 50,000 of the loss will be compensated by the first insurance company and 50,000 will be covered by the other insurance company. Only the loss amount will be compensated. Next policy is mitigation of loss. See, according to the mitigation of loss, it reminds the insurer of his duty to take all necessary steps to minimize or mitigate the loss. If you have taken a fire insurance, then the first condition is that you should have taken all the measures required to protect that building from fire. You should have fire prevention or fire protection tools and equipments. You should have used well insulated wires and you should have taken all steps necessary as though you have not taken insurance. And even after taking all that precautions, you have suffered a loss, then only you will be compensated. Next principle is causa proxima or proximate cause. So there will be several causes for a loss, but the insurance company will only indemnify the insured when the loss is caused by the peril insured against. Suppose your ship carried a few bags of rice, and these bags of rice are destroyed by seawater which entered the ship through a hole made by rats in the bathroom pipe. In this case, the insurance company was held liable for payment by the court because the proximate cause of loss was seawater and not rats. However, if the loss was directly caused by rats, the insurance company would not have been liable. The next one is cooperation. See, I've already explained insurance is a cooperative device. A lot of people who face the same risk will come together. They'll pay a certain amount as premium and the person who suffered the loss will be given a fixed amount. So this is what is explained under the cooperation principle. Last principle is principle of warranties. A warranty is a stipulation by which the assured undertakes that some particular thing shall or shall not be done. That is, the certain condition shall be fulfilled. See, a warranty is strictly enforced in case of marine insurance. It is a condition which should be fulfilled by the insured and the breach of this condition will relieve the insurance company from its liability. Now, warranties can be express or implied. Express warranties are expressly mentioned in the contract. Implied warranties are not mentioned, but we know that it should be followed. That is, suppose in the case of marine insurance policy, it is a warranty that in every voyage policy, the vessel should be seaworthy. That is, it should be in good condition. The voyage should be for a legal purpose and not for any sort of an illegal activity. There should not be any deviation from the agreed route. These are all warranties or conditions which should be met by the insured in order to get insurance coverage. In case of any violation of these warranties, then the insurance company will not be liable to compensate the loss of the insured. So these are the major principles of insurance. So I hope this much is clear. We will discuss the other topics in the next class. Thank you.